Okay. So we started with portfolio way of investment, and I explained that day like the portfolio way of investment is something which is preferred by certain kind of investors who doesn't want to take that much of risk. That means who wants to minimize the risk, who want to invest, but they want minimization of risk. Correct? They want to mitigate their
Yeah.
risk by making a portfolio which suits their risk appetite. In the sense, I said if you are investing in XYZ corporation, which is a single company, if this company goes into losses, there's a big chance, and there's a sure chance or certain chance that you may lose your entire money. But if you invest your money in some 5 companies, XYZ, ABC, PQR, DEF, and anything else you can put it into. So suppose if you are investing in these 4 companies and making a portfolio of these 4 companies, then if XYZ, even if there's a loss in XYZ, the others are giving you returns. Am I right? So altogether,
Yeah.
this loss can be absorbed in these returns. Isn't it so?
Yeah.
That is the benefit of diversification. And I told that day that there is only one kind of risk which prevails or which exists, that is systematic risk. What is that?
Systematic risk.
Because if you are investing in just one company, which is XYZ corporation, there is unsystematic risk. What risk?
Unsystematic.
Why it is
Yeah.
unsystematic risk? Why? Because
Because-
you are investing in just one single company, which is a part of the system. Correct? Which
Correct.
is not the complete system, it's a part of the system. That means it is a part of the market, stock market. So if this particular company in which you are investing, the risk is unsystematic risk, it's an understood fact, and unsystematic risk can be minimized through
Diversification.
that means you can minimize this risk through diversification. Okay, but if you have invested in some index stock, Bombay Stock Index stock, BSE stock, which has 30 companies altogether as participants. Now if if there's a crash market, if the market crash, then every stock which is a participant of this market would lose. Am I right? Because it is a
Yeah.
systematic risk. Am I right or wrong?
Yeah.
Which cannot be reduced or minimized because further diversification is not possible in this case. Okay.
Correct.
Now comes the coefficient of correlation in portfolio theory. So what is this coefficient of correlation? You should understand. See, coefficient of correlation is denoted by letter called R. Okay, R is a letter which represents coefficient of correlation. So the correlation coefficient shows the strength of the relationship between two variables. It shows the strength of the relationship between two variables. Let's say I take two stocks. That is Kotak and HDFC, and I just put Kotak as X and HDFC as Y, and I just found out the correlation between these two, and the correlation happens to be 0.70. It is a positive correlation between these two. That means what does it show? If the Kotak stock would go up, there is a 70% chance that HDFC stock would also go up. Correct?
Right.
That is the strong relationship they have. If it is 1, then if Kotak stock goes up, 100% chance that HDFC stock would also go up, or if Kotak goes down, 100% chance that HDFC would also go down. That is what is it's called perfect positive correlation. But if it is minus 0.70, then if Kotak stock goes up, 70% chance that HDFC stock will go down. Okay, so So this is negative correlation. In this way, we see the strength of the relationship of two variables, and correlation coefficient explains us that. And you should know always that correlation coefficient always lies between -1 and +1. So between -1 to +1. Okay, next. We are done with this. Now we are entering into introduction to long-term financial management. Okay.
Okay.
See, one thing I would like to explain you. Long-term financial management. See, we require finance to start our business, correct? That finance we have two types of goals: short-term goals, long-term goals. To fulfill short-term goals, we want short-term finance. To fulfill long-term goals, we want long-term finance. Short-term goals can be increasing the revenue or earning the profits. Long-term goals can be something different, expansion of the business, acquisition of any other business, starting new operations in other countries. It can be long-term goal, correct? So short-term we
Right.
are not discussing right now because our topic is long-term. Long-term capital you can arrange in various ways, in the form of equity, in the form of preferred stock, in the form of debt finance. Okay, that is in the form of long-term loans or bonds, anything. Now, external funds. External funds, I said you, long-term debt, which you can arrange from any bank, or you can sell bonds to public and you can arrange your funds, correct? And in any ways, if you are borrowing money, it's a big amount. You have to definitely mortgage your property with the bank, or you have to give asset-backed securities at times to the public, correct? Hello.
Yes.
Then comes the preferred stock. It is also one of the ways to borrow funds. And one thing I would like to tell you about long-term debts. See, easily available. Second is it's like very, very risky. Okay. From the investor's perspective, it is very secured type of investment. Why? Because there are a lot of covenants or conditions in this bond. That is, the company, if it goes bankrupt, they have to sell their personal assets and they have to give the money back to the bondholders, correct?
Correct.
Bondholders get interest, and the advantage to company in this case is interest is tax deductible. What is that?
Tax deductible interest.
That means company can claim deduction for interest expenses what they are paying to bondholders. In this case, what would happen is company can save lot of cash. Okay, that reduces their tax liability. Understood? That is not the
Okay.
case with the equity or preferred stock, because there the dividend payments whatever company make cannot claim deduction on that. Those cannot be considered as expenses.
Good. Correct.
Preferred stock, company has to pay fixed dividends to the preferred stockholders, and those are also redeemable.
Okay.
Okay, and preferred stock dividends can be paid fixed. If more profit or less profit, it doesn't matter, but the dividends are paid fixed. Next, it has feature of a bond as well as equity. See, preferred stockholders get dividends like equity holders, and they get fixed dividends like the bond holders who get fixed interest, correct? And these people do not have voting rights in general. Okay,
Okay.
I'm not speaking about some special exceptional cases. We'll get back to that. Equity. Investors get dividends at floating rate. More profits, more dividends, less profit, less dividends. These are the actual owners of the business. Okay. They get voting rights. And these people have the highest risk actually. Because if the company goes into losses or whatever the case, who is going to bear? The actual owners, correct?
Correct.
Internal funds can be retained earnings. If company has started business, it is making profits, it will retain its profits, and those profits it can use in the future for reinvestment purpose, correct?
Right.
Capital structure issuing debt or equity. See, firm's capital structure can be a mixture of debt and equity, and they have to, the company's management has to decide what is the ideal capital structure for them. Okay, so usually optimal capital structure is reached by using some of each of the different sources of financing. The optimal allocation of financing among the different types of capital will be made by taking into account many different considerations. What are they? Future prospects of the company. If there is a higher business risk, the more conservative it tends to be in its financing sources, correct?
Right.
Because they would be more conservative, like that means they would not be taking much of the chances to get some funds whereby they think it is not safe for them. Second, equity markets. If equity markets are doing poorly, then the cash received from sale of stock in IPO would be less, and it would be in a period of, that means if the markets are strong, then they can get good funds, but if the market is poor, investors will be reluctant to give money, correct?
Right.
Then they have to decide for other alternatives, and the amount of risk the company is willing to accept. Debt is very risky, so if the company wants to take debt finance, it should be prepared, it should prepare itself for that by considering the risk factors. See, if equity, in by way of equity, if the company is not getting funds, it has no other option rather than taking debt, but it should be prepared to face the consequences. If there is a mismanagement happening in their company, they should ensure that they should earn consistent profits. Now, depends upon the reputation of issuers also, and the interest rate it would need to pay in order to be able to issue debt. See, if Tata company is issuing bonds, people will buy because it has a very good reputation, correct?
Right.
Now, then the company also should consider the cost of each source of capital. So I'm speaking about KD, which is cost of debt. I'm speaking about KE, which is cost of equity, and I'm speaking about KP, which is cost of preferred stock. They should see what is the least. They should go for such combinations which can be least source of, which can be which can be such a source whereby the cost of capital should be least. What is that?
Cost of capital should be less.
Yeah. Next. Now we are coming into the next topic, cost of capital. See, what is cost? Suppose I have taken some loan from some bank of 1 lakh rupees. Bank is charging me 10% interest. For me, that is,
Cost.
for bank,
Correct. Return.
okay. So cost of capital, that is, to someone, to some it is cost, so to some it is returns. Fine.
Right.
So cost of capital, cost should always be equal to returns. That means to one party if it is cost, to another party it is returns. Now, first we'll start with KD, cost of debt. Okay. Actually, they have introduced something else. I'm going into cost of debt. I'll first finish the cost thing. Okay. Cost of debt.
Cost
So
of
cost,
debt.
Yeah, cost of debt formula is CD or KD, whatever you want, you can write. C, that is the interest cost into 1 minus tax. And I already told you na, that interest is tax deductible, correct?
Interest is tax deductible. Yeah.
Yeah, suppose if it is 10,000, 10,000 is the interest expenditure for me. To me, the cost would be only 7,000 because 3,000 can be claimed as deduction. Understood?
Could you explain it again?
See, this is company's financial reports. This is taxable income before interest.
Okay.
Financial report is 1 lakh.
Okay.
Taxable income is also 1 lakh, let's say. Coincidentally, just a second.
Interest is tax before tax amount is converted to an after tax and the interest rate and multiplying it by 1. Cost of debt to be sure is the interest rate required by the investor adjusted for the tax liability of the interest. The evidential monthly interest refund is less than the amount of because of the tax liability.
Hello.
Yeah.
Hello. Yeah,
Yes.
this is the financial report. This is taxable income. So before interest, this is the PBIT, let's say. So I'm deducting the I'm claiming deduction of interest here, correct?
Yeah.
This gives me 90,000 of taxable income. So actually, as per the financial reports, I have to pay tax of how much? 30,000. But I'm paying how
Yeah.
much? So 3,000 is the saving, na?
Yeah. The weightage
That is
adjustment.
because of this deduction, correct? This is cash
Right.
saving. This I'm putting in my cash account. So my total exact cost is 7,000 only, na? Because 3,000 is saved, correct or wrong?
Right.
So always, whatever the case it is, interest into 1 minus tax rate you should take to calculate your cost of debt. Okay. Do this question. Today Pramod has come after a long time. Finished? Hello?
Yeah, just reading the example.
Yeah, okay. No, if you want, I can explain you. Are you doing?
Yeah, yeah.
Trying?
Explain.
4 years ago, Lordstown Inc. issued 1,000 8-year bonds that pay 6% coupon rate annually. and proceeds from bond issue. That means the bond face value is this. They sold it for this much. Okay.
No, for
What is the
970.
what is effective annual interest rate? 7.4%. Fine.
Okay.
And the discount rate that equated the present value of bonds, future cash flows with initial market. So this this is the effective annual rate. That means which is prevailing in the market. This is used as discount factor. What is that?
Discount factor.
Discount factor. The market price of Lord Town's outstanding bonds currently is quoted as 107.75, which means that for 1000 it will be 1017.50. This is the market value of the bond. Market value of the bond.
Okay.
Okay? This is the tax rate. Current market price of similar term and risk characteristics is 5%, 5.5%. That means currently in market, similar bonds are paying 5.5%. Understood?
Right.
So you should always take what is the before tax cost of debt from accounting perspective is effective annual rate. This is the 7.4% is the cost of debt. Am I right?
Yes.
And
Annual
into 1 minus tax rate will give you the exact cost
5
of
point.
debt finance. Yeah. And the before tax cost of debt from a cost of capital perspective.
Which is
See,
5.5.
actually 7.4 is what actually from accounting perspective in the market right now currently if some investor wants to invest, what will he get in the market?
5.5.
So if we remove the tax rate, 4.4. This is from investors perspective, this is from accounts perspective. Okay,
Okay.
but we should consider only investors perspective, not the accounting perspective. Understood?
Okay.
Is more relevant because we are looking from the cost of capital perspective, not accounting perspective. Understood?
Okay.
Yeah, have a look through this, then we can move to the next one fast.
Okay, go ahead, sir.
We'll go for cost of preferred stock. First, I will finish the cost of capital section. Cost of preferred stock. To find out the cost of preferred stock, the formula is annual dividend by share price. Here we should take market price. What we should take?
Market price.
For example, the company is paying a dividend of $10 and the share price is $100 in the market. The cost of preferred stock is 10%. Correct? Yes.
Okay.
That means company is paying 10% dividends. It's a clear, it's a clear, clearly understood fact. Am I right?
Okay.
Hello. Yeah. See, the cost of preferred stock KP is equal to dividend by share price. Formula. Dividend is $10. Share price right now in the market, trading in the market is $100. 10% is what you're getting. That is what you can see now. It's very evident, it's evident and clear that of whatever the stock it is trading in the market, the investment is of how much value? $100. Suppose you bought a stock for whatever value, but today it is trading at 100 value, $100. It is giving you how much of that? 10%, correct? That's
Okay,
equal to
right.
$10. Am I right?
Yeah.
That is your return. That is what to company? That is what to company? Cost. Correct?
Yeah.
Please have a look to this question. Whatever return you are earning, it is cost for the company. Clear? It's a clear fact.
तो ये कौन सा पेज नंबर है? Preferred stock. So I'm unable to get this.
Page number 158.
और आगे चलेगा.
158. 158. See, in between they have given lot of concepts. We will cover everything, but I am covering only cost of capital specifically today.
Okay.
Actually, in the old book, the cost of capital was a separate topic. But in new book, what they have done is they have just scattered the topics. Hello.
Yeah, sir.
Yeah, we can do this question, Suma. Shall I explain?
Yeah, checked it. Teller वाला ना?
Yeah. Steeler Corporation's 28,000 shares of preferred stock and the par value is 100. It is trading at $98 in the market. You have to take only market price, So market price is taken. The dividends what they are giving is 5%, which is $5.
Yeah.
So the cost is 5.1%. Okay.
Yeah.
This is the formula. Do this question again. See, what they are saying is.
That is the formula for the other ones, the cost of newly issued preferred stock.
This we did, right? Yeah. I'll tell. Explain with the formula. See, whenever you issue some stock, there is some issuance cost also you incur, correct? Hello.
Okay.
So that you need to just take net proceeds. What do you have to take?
What is net proceeds?
Net proceeds per share issue. So what is net proceeds per share issue? Whatever the money you will be getting when you will be selling the share. Suppose here the money what you're getting is $35. There's a flotation cost of $3 per share. We have to deduct that, na? You have to remove
Okay.
it. Hello.
42.
So
Yes.
after removing, we get the net proceeds from issue of from share issue. Okay. So
Okay.
dividends here is 5%, which is like the par value is $50. So $50, 5% is 2.50. Fine. That is a
Yes.
dividend. And the net proceeds from share issue is $32. So your cost of preferred stock is $7.8.
Okay.
7.8%.
So we have taken yearly dividend per share. That was,
Yeah, dividend per share 2.50 divided by 35 minus 3,
yeah.
which is like share price, selling price of the share minus issue cost.
Okay.
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 Done. We will continue with the cost of equity in the next session. Okay, Suma?
ठीक है.
Yeah. Thank you.
Okay, thank you.